Motley Fool is out with a new small cap stock recommendation, and they claim it's like buying Nvidia in 2017. I reveal the stock here for free so you don't have to buy the Fool's newsletter. No paid or proprietary info is given away here, and it's all guesswork based on clues in a publicly available email. Let's quickly look at the Fool's recent performance before we do anything. They recommended Alphabet in September 2024, and this stock is up a bit. Amazon was also recommended in September 2024, and this one is up a bit as well. Meta was also recommended in September 2024, and this one has performed the best of the bunch. The Fool recommended Lincoln Energy in November 2024, and the stock is seeing a little surge lately. At the same time, they recommended EQT, a natural gas stock, and this one is up too and has paid a nice dividend. BWX Technologies was the last energy stock recommended in November, and this one has done pretty well too. They recommended 5 microcap stocks in February 2025, and the first was Serve Robotics, which is down overall. Canixa Pharmaceuticals was the second stock, and this one has done really well and has almost doubled already. Ituran Location and Control was the third stock, and it's down slightly so far. The fourth stock was Carrot Packaging, and this one is down too. Karoo was the last company recommended, and it's about break even. Let's shift back to the email the Motley Fool sent and look for clues for the stock now. Here's what the Fool says. The phone is ringing off the hook. That's what the CEO of a rare earth supplier said after China restricted exports of critical materials like gallium. This tiny firm, roughly 1/80,000th the size of Nvidia, could be a key player in the AI supply chain shift already underway. They continue and say, "You've probably never heard of this company. I hadn't either, until a colleague dropped a report on my desk and said, 'You need to see this.' It led me to a tiny Canadian firm at the center of an AI resource bottleneck, and I believe it could create serious wealth for early investors." How tiny? Roughly 1/80,000th the size of Nvidia. Its entire market cap is smaller than what Nvidia trades in a single afternoon. And yet it's quietly refining the materials that make AI, EVs, and advanced semiconductors possible. Most investors are focused on the obvious players in AI, the chatbots, the apps, and the chip makers building the brains behind it all. But none of it works without the physical infrastructure and the rare earth materials behind it. More than 90% of those materials still come from one place, China. That's exactly what puts this company in such a rare position. And despite researching stocks daily, I had never come across it. But after reading the report, I was blown away. The Fool continues and says, "I quickly realized this might be one of the most compelling opportunities I've seen in my time at the Motley Fool. This firm is embedded across AI, EVs, green energy, and defense. Yet it's flying under the radar. No Wall Street buzz. Almost no analyst coverage. But their role? Critical. They manufacture magnets for high-efficiency EV motors. They supply gallium, indium, and hafnium for semiconductors and aerospace components. They make cooling parts for the machines powering AI. And when it comes to competition, there isn't much, at least not outside of China. With facilities in North America, Europe, Thailand, and the UK, they're one of the few positioned to benefit from the global supply chain reshuffle. Just recently, China restricted exports of key elements like gallium. Governments are now scrambling to secure stable domestic supply. And finally, the Fool says, as one official at the US Department of Defense put it, it is more urgent than ever to build capability and resilience in supply chains for critical minerals. The few companies that can supply them outside China are now in very high demand. The story isn't getting much attention yet, but in the CEO's own words, the phone is ringing off the hook. Everybody wants to talk about how they can satisfy their demand out of our facility. I'm going to reveal the stock in about 20 seconds, but before I do, I want to remind you to click the link in the description to check out AlphaPicks. I reviewed over 100 stock picking services, and this is by far the best, and is one of the few that actually beats the market. Plus, my viewers get a $50 discount you can't find anywhere else. So after you're done watching this video, make sure to click the link to get this discount. The stock being pitched here is Neo Performance Materials, and this is an over-the-counter stock with the ticker NOPMF. Here's what to know about this stock, and after I'll tell you if I'd buy. Neo Performance Materials is a Toronto-based materials company specializing in the production of rare earth elements, magnets, specialty chemicals, and alloys. In recent years, the company has undergone a strategic transformation, divesting its Chinese separation assets to reduce exposure and streamline operations. This shift reflects a renewed focus on downstream magnetics, positioning Neo to capitalize on growing demand for advanced magnetic materials used in electric vehicles, renewable energy, and high-tech applications. Neo Performance Materials is currently trading at $15.73 Canadian under the tickers TSX Neo and OTCQX NOPMF. Over the past year, the stock has delivered a remarkable 120% return, outperforming the TSX by approximately 85%. Analysts maintain a consensus rating of buy or outperform, with an average price target of $19.40 Canadian, suggesting continued upside potential. In 2025, Neo Performance Materials stock experienced a twofold increase, rising from $7.80 Canadian to $15.73 Canadian over the course of 12 months. This impressive growth was largely driven by strong operational execution and the successful divestiture of non-core Chinese assets, which reinforced investor confidence in the company's streamlined and forward-focused strategy. Analyst sentiment toward Neo Performance Materials remains positive, with a consensus rating of buy or outperform. Currently, 3 analysts actively cover the stock, projecting an upside potential of approximately 25%. Reflecting growing confidence in the company's strategic direction, Stifel raised its price target in mid-2024, supporting the bullish outlook. Neo Performance Materials delivered solid financial results in Q1 2025, with revenue holding steady year-over-year at $121.6 million and adjusted EBITDA climbing 59% to $17.1 million. This drove a notable improvement in EBITDA margin, rising to 14.1% from 8.8% the previous year. Adjusted earnings per share came in at $0.09 for the quarter. On the balance sheet, the company reported $77.3 million in cash, a net cash position of $6.2 million, and capital expenditures of $6.8 million, including $3.9 million allocated to its European magnetics facility. Looking ahead, Neo is projecting full-year 2025 revenue of $642.4 million and EPS of 0.49, with earnings growth forecasted at an impressive 118% annually. Neo Performance Materials holds a strong competitive position as one of the few downstream rare earth producers operating outside of China. The company is strategically focused on scaling its permanent magnet production in Europe and advancing heavy rare earth separation capabilities in Estonia. These initiatives align with growing global demand driven by electric vehicle traction motors, industrial robotics, wind turbines, catalysts, and water treatment technologies, sectors where reliable, non-Chinese rare earth supply is increasingly critical. Neo Performance Materials is trading at a trailing price-to-earnings ratio of 21.2x based on its share price of $15.73 Canadian, with an enterprise value to EBITDA multiple of 23.5x. These valuation metrics are moderate compared to peers like Lynas and MP Materials, reflecting a balanced outlook between growth potential and current earnings performance. The stock also offers a 2.5% dividend yield based on trailing distributions, adding an income component to its total return profile. Neo Performance Materials is positioning itself for long-term growth through several key catalysts. The company's European magnet facility, expected to be commissioned in 2026, has already begun shipping 18,000 sample magnets to a Tier 1 electric vehicle customer, signaling early commercial traction. In parallel, engineering is underway for a heavy rare earth pilot line at its Silmet site in Estonia, which would further strengthen its supply chain independence. While revenue is projected to remain relatively flat, earnings are forecast to grow at an impressive 118% annually, driven by margin expansion and operational efficiency gains. Neo Performance Materials presents a neutral to cautiously positive investment outlook. On the positive side, the company is demonstrating strong margin expansion, maintains a clean balance sheet, and is actively building rare earth processing capacity outside of China, an increasingly strategic advantage. Favorable demand trends in EVs, renewables, and advanced manufacturing further support its long-term potential. However, risks remain, including a flat revenue outlook, limited analyst coverage, geopolitical exposure, particularly in Eastern Europe, and execution risk tied to the ramp-up of its European magnet facility. If the company delivers on its strategic initiatives, the stock could see upside into the Canadian dollars 19 to 20 range. So what do I think about this stock? Before I answer that, I want to talk a little bit about the rare earth sector. Stocks in this sector have been hot lately, and many rare earth stocks have exploded in price, like MP Materials. There are a lot of reasons for this. Rare earths are crucial in many fast-growing sectors. For example, electric motors, wind turbines, and many defense applications all depend on rare earths. The reason the rare earth sector is so hot right now is because there's a push to decouple from China, which currently refines about 80% of the world's rare earth elements. The refining process for rare earths is expensive and difficult, so building a supply chain outside of China is both important and challenging. Because of this, many countries are treating rare earth refining as a matter of national security. This is true for many Western nations in places like Japan. Outside of the difficulties in refining rare earths, there's also the issue of price volatility. Since China controls so much of the rare earth supply chain, they essentially control rare earth prices and will likely fight to keep this control. China can easily manipulate prices by flooding the market, which would make it hard for rare earth refineries outside China to remain profitable. This risk is somewhat offset by government spending. For example, the US government awarded MP Materials a $400 million contract on national security grounds. The takeaway is, rare earths, while a very hot sector, are also very volatile. Many companies in this space are small and pre-revenue. you'll have to be comfortable with that risk. Neo Performance Materials seems to be well positioned in this market and is one of the few vertically integrated rare earth refiners. Their technology is difficult to replicate. For example, their MagnaQuench segment, which creates magnetic powders used in bonded and hot to form permanent magnets, essential components in electric motors, generators, and other electromagnetic devices, took 35 years to develop. Neo's position as the only gallium recycler and refiner in North America gives it a unique competitive advantage and exposure to growing demand from the semiconductor and renewable energy sectors. The fundamentals of the company are a mix of good and bad. Revenue had been declining after rare earth prices peaked in 2022, but more recently it has stabilized. Revenue was basically flat from Q1 2024 to Q1 2025. However, margins are improving, which demonstrates operational improvements. Overall, Neo Performance Materials is built on the convergence of several powerful secular trends that position it at the center of the global energy transition and supply chain localization movements. Neo represents a unique opportunity to gain exposure to critical materials through a company that has demonstrated operational excellence, maintains strategic assets, and is positioned to benefit from multiple long-term growth drivers. I personally think this company is a good buy for its strategic importance, hard to replicate technology, fair valuation compared to peers, and strong long-term trends favoring its position. And make sure to click the link in the description to get $50 off Alpha Picks. I reviewed over 100 stock picking services, and this one is by far the best. And they don't do any scummy marketing tactics every other company engages in. So if you want to put yourself in the best position to make money with stocks, click the link in the description now.